Okay, good morning, everybody. I'd like to welcome you all to the Daily Energy Markets podcast. It is Thursday, September the 7th. I'm delighted to be back hosting the program and to be joined today by three of our regular commentators, Mike McClone, Senior Macro Strategist at Bloomberg Intelligence, Osama Rizvi, Energy and Economic Analyst at the Primary Vision Network, and soon to be joined by Dr. Yusuf Al-Shamari, CEO and Head of Oil Research at Sea Markets and Senior Research Fellow at Imperial College London. Good morning and thanks everyone, and great to have you all back. Mike, let me start with you. Things aren't going your way, are they, Mr. Bear here? We've seen oil prices rally up to $90 now and break through that. And our survey question yesterday had 67% of our listeners at least thinking it might hit 100 by the end of the year. So give us your analysis ahead of the fourth quarter now, and let's have a catch up.
Yes, I do appreciate that, Mr. Bear. I've been called Mr. McClone, and I do appreciate it because he's pointing out facts. I did point out last year when crude oil was above 100, and I expected to go to 40. This year's low is 63. Darn, didn't get that close. Now that was using WTI. I fully expect it's still going to go that route, heading lower. I think we're near the upper end of the range. In both TI and Brent. We might print 100, but this is the key problem with crude oil, and throughout most of history, it's the most autocorrelated commodity there is, and moving higher just squash that demand, increase the supply, make markets move lower. Now that's the macro bigger picture. The shorter term picture is the globe is tilting towards a recession. Now, yes, we've heard that. We've been early. Our models in Bloomberg Intelligence started at 100% just about a year ago for the next 12 months, but it's just starting to kick in. And the key thing is I look over as we see deteriorating growth out of China. That's a known. That was a big difference from last year. We see recession kicking in Europe, and we see the same thing tilting this way in the US. The key fact is the Federal Reserve and most central banks still have their button on the tightening button. So I fully expect that crude oil is going to continue to drop and follow natural gas. Natural gas did what I expected last year, dropped at 80%. It's still hovering around 2. That's the same price as it traded in 1990. And I'll end with this. At least there's one commodity I'm bullish on, and that's gold. The average price for gold this year is the highest ever, around 1933. It's hovering around that price. And the average price of WTI around 76 was first traded in 2007. I suspect it's going to trade back down and gravitate lower towards those lower levels and more of an enduring bear market.
Okay, thanks, Mike, for that. Yusuf, welcome. Good to have you on the show, and welcome back. Let's take those comments a little bit that Mike just made on the oil price, on the direction that he thinks things will turn again too. Give us your thoughts, Yusuf, first on OPEC Plus's move this week, Russia and Saudi specifically, on extending their cuts. Not a surprise, but to the end of the year. Some people saying that. I mean, again, that's a sort of, I suppose, market management tool, isn't it? They can change their minds again any time. But what do you make of that?
Good morning, Diala, and good morning, everyone. Very delighted to join you again. First, the extension made by Saudi Arabia and Russia have been long expected, yet not confirmed, because there could always be a change subject to market conditions. Yet what we saw over the past couple of days shows me not as surprising in terms of the extension, but in fact in terms of the alliance, the very strong alliance between Saudi Arabia and Russia. Because now we see Saudi Arabia, because I thought Saudi Arabia is willing to extend. They've made these statements before. They were also saying that they are happy even to deepen the cuts. But we haven't heard really any clear statements coming from Russia. Of course, Saudi Arabia wouldn't extend on its own. So what we saw is this joint alliance between Saudi Arabia and Russia even is curbing its exports, which is actually very, let's say, can be monitored more accurately because Russia doesn't publish its production figures, has sent a very strong signal that the two countries and the alliance as a whole is in a strong agreement. And that has been the main reason why we saw almost a 2% jump in prices over the past couple of days. So I think here, in fact, I don't think they will like relax or ease these cuts. I think these cuts will stay in place until the end of this year. There's a question if these cuts will go through 2024. But here it's the uncertainty if prices will hit $100. If it does, then I think there could be some easing in these cuts.
Okay, thank you. So let me just stop you there for now. Okay, that's interesting to say that you think of the $100 mark would be the sort of trigger point for OPEC plus. I mean, just to make a point there that Russia and Saudi are cooperating, but Saudi has been happy to do its own thing all year, whatever it takes, without Russia, really, practically. Now Russia happens to be joining because it's kind of its production is dropping perhaps organically. But Osama, let me go to you with that in terms of, I mean, Pakistan, obviously where you're based, but also just in terms of consuming nations in general, and particularly those in South Asia. That must be hurting quite a bit now that we're hitting $90. And, Yusuf saying OPEC may let it get to 100 before, we see that demand destruction maybe, which may turn things around. What's Pakistan's position and other countries in your position, if you like?
Yeah, that's very interesting actually, because only recently, I received my electricity bill, which registered a 100% month-on-month increase. In 1 month, the electricity bill increased 100%. So if you look at the news here in Pakistan and there are tons of other developing countries in the global south that have been facing serious protests due to rising electricity costs or generally energy costs. So absolutely, the rising oil prices are sort of wreaking havoc here. Especially, it's sort of a poly crisis playing out in Pakistan and countries like us, where we have climate conditions worsening, we have an impending food crisis because of the rising interest rate and the strengthening dollar and the depreciating local currencies. We have a huge debt crisis, right? So we have about half of this year's Pakistan's budget would go in debt servicing. And this speaks to the wider macroeconomic picture as well. And I keep following Mike on LinkedIn and Mr. Yusuf as well. And I agree with both of them, especially Mike when he says, so if you look at the global indicators, even in terms of developing countries, in the last 2 decades, there have been about 19 defaults or something like that. But in the last 4 years, there have been 15 defaults. Sri Lanka and some African countries, some Latin American countries. Pakistan just averted one. So I think it's always the case that the global macroeconomic conditions have a disproportionate effect on countries like us, because there are already a lot of a certain set of problems that we tend to face. So definitely, if oil prices at $100, which maybe in the shorter term would be possible, not founded on fundamentals, certainly only sentiment based. So we are going to see some serious issues. Petrol price just hit around $1 in Pakistan. I'm expecting another 100 PTR increase. So that would definitely spill over into the social reign as well. So I'm looking at a lot of trouble in the country.
Yeah. I mean, it's not short of any problem, certainly. Mike, just to talk about petrol prices, let's talk about the US a bit. Gasoline is creeping up. They're obviously being pushed by the crude price. How is that going to impact, obviously, a policy in terms of Fed sensitivity to how inflation now is getting some support again, isn't it? It's going to. A lot of people say, well, oil and inflation are unrelated, but that's not true, is it? And just when the Fed was getting it right, they may be challenged again by a big factor in their price index.
Dali, you just described the lose-lose for virtually all commodities and risk assets at the moment, and the strength in the dollar. The Fed is still on a tightening path. If you look at the WIRP function on the Bloomberg terminal, the next 2 meetings, as we get into the November meeting, there's still a chance, a 40% chance they're going to keep hiking rates. So typically what it takes for markets to bottom crude oil, copper, stock market is we need a long and variable lag to Federal Reserve easing. They're still tightening. So they're still have their finger on the tightening button, and that's part of what's happening. At some point, we're all going to roll over. Yes, it's been delayed, but that's the problem right now with this rising unleaded gas. It's around $3.80. The peak last year was $5. I expect it to go down to $2.80. That's very much not profound. That's about the average price of the last 20 years. And that's just usually what it does as you tilt towards recession. The key thing is, how do we avoid a recession? It's almost inevitable in this country. And then the key things you have to watch is the U.S. is a net energy exporter, obviously net exporter of LNG, natural gas, crude oil, liquid fuels. That's the paradigm shift that shifted from 10, 12 years ago. The key thing is what's happening in China. And now we see U.S. rates have moved so far, so fast. They're about 300 basis points, a two-year note above China, which is an accident waiting to happen. Then you look at U.S. imports from Mexico, they've actually surpassed U.S. imports from China for the first time in 20 years. So there's a significant shift, reshoring, getting out of China from this country and Europe, and a lot of that's based on some of the political policies. This is an global economic train wreck recession heading that way. And the question I ask is, what stops it? And OPEC cutting supply, we all know why they're doing that, because they see the demand destruction, but that's only going to hurt the process of tilting things lower. The question I ask is, what stops the trajectory? Now, we've seen a bounce. I fully expect things to start rolling over, particularly when the U.S. stock market rolls over for a typical recession.
Okay, and let me just stick with you, Mike. You mentioned China. I just want to get your thoughts on that from a monetary policy point of view. They've had the stimulus stimulus program, but they've sort of been resisting a bit, haven't they? And that is, but partly to protect their currency, etc., their trade advantage. Do you feel? I know there's a feedback you're getting that they will push any harder on putting cash out there and pushing their economy higher.
It's one of the things we have to expect in life, like daytime coming after nighttime, that they will stimulate. We should expect more of that, but it's not they anymore. It's one person. That's what's changed in China. It's President Xi, and it's become very autocratic led. So we should expect more stimulus. But from my Bloomberg intelligence colleagues, the property crisis, the situation in China is just getting worse, and they're just reacting to it. But it's inevitable. It's something that's been working for happening and building up for 10 years. They've just upset their biggest export customers, and they have a crisis of confidence internally. That's not going to be fixed right away, even with stimulus. It's going to provide bounces, but I think those bounces are going to be sold in the big picture. So this is somewhat, it's right now a significant trend that's almost unstoppable. Is China in decline or deteriorate? I would say the demand estimate revisions in economic growth, exports declining, and the crisis in confidence internally. That's something that's been kind of building up for about 10 years. And now we have, I just like to end with this, just watch what President Xi is doing. He's pushed back on capitalism with pushing back on Jack Ma, and he's embraced Mr. Putin and this war in Europe, and that is not good for any of his export customers. And that's what really brought China out of low per capita income the last 20 years, is major significant exports. That's shifting completely.
Yeah, that dynamic is turning around, isn't it? Yusuf, let's talk a bit about, we have a bulletin on our headline about the refining industry and how, at the moment at least, it seems to be pretty squeezed under investment, under capacity, although in this region, in the Middle East, in the Gulf, a lot of new capacity coming on board. But what do you think the outline is there for the refining industry in general? Is that going to continue to sort of support product prices because there's a lack of literally production and capacity, or is this just a temporary blip?
Well, I'm pretty much concerned about, investments in refining sector. In fact, refining as well as the upstream exploration and production sector. But here talking predominantly about refining sector, I think the industry is in a shift, and they're worried about future demand for fuels. Pretty much that can be partly driven by the shift towards alternative modes of transport, could be electric mobility, and alternative modes of even reduction in fuel demand itself due to more efficient vehicles, hybrid vehicles, and so on. So that is actually to me, this has been a major driver why we're seeing refining underinvestment, especially in Europe. In fact, there has also been refining closures in Europe. In the Middle East, the situation tends to be slightly better because of upcoming demand, and we're seeing many countries in the Middle East now expanding their refineries. We saw it in Kuwait, even in Saudi Arabia and many other countries. I think also in Asia, that is where we could define refining capacity as expanding. Yet, what does that mean? If you look at the refining margins, they've been pretty much higher than previous levels. And part of that actually is due to, it shows that there is a tightness in fuel supplies, not just on the upstream side. So I think here, if oil companies will continue to divest from the oil industry due to pressures from shareholders or any political pressures, then there could be a refining crisis in the years ahead.
Yeah, and of course, I mean, it's self-perpetuating, because by making the supply tight, I suppose they protect those margins as well to an extent. But thanks for that, Yusuf. Osama, just back to you on crude imports into Pakistan. Earlier this year, when you were negotiating the IMF deal, etc., there was a lot of sensitivity over whether Pakistan would be taking Russian crude at an advantageous discount, as India has been all year. What's the update on that, and the tendency for Pakistan to sort of select, if you like, within the choices that it had?
Yeah. So interestingly, we have discussed this very issue on this podcast quite a many times, and I was never hopeful regarding this a new endeavor that Pakistan was taking, because I think there was a lot of diplomatic as well as economic and technical hindrances to this development. Nevertheless, we did the experiment, and the experiment failed as expected because there were lots of reasons. First of all, and most importantly, our refineries were tuned to processing the crude from UAE or Middle Eastern countries, whereas this was the first consignment ever. So there were technical hindrances right from the start. Other than that, what the Russian crude was yielding was so the Pakistan mainly requires oil for the high-speed diesel and a little bit of furnace oil. So this ratio is 40 and 20% when we talk about Middle Eastern crude. Whereas for Russian crude oil, this was the opposite. We were yielding about 40% furnace oil and 20-25% high-speed diesel. And eventually what the refineries had to do was they had to mix the other oil as well. And that was, so the net effect was we were getting it for the same cost. The freight rates was also another reason. And as expected, there was not even a single rupee or a cent of a difference between petrol prices after the experiment. So I think even moving forward, until or unless we upgrade our refineries, there has been some talks with Saudi Arabia where they're going to build a $10 billion refinery in Pakistan. We'll see when that happens. So I would have my doubts regarding any future development as well.
Okay, thanks, Osama. Mike, you mentioned that gold's holding up pretty well historically. Give us your thoughts on where the dollar is headed in contrast or in tandem with that. I mean, you made some reference earlier to commodities and other prices, but have we seen it peak yet, or do we still have some strength to come?
Now, that's the problem. The dollar is breaking things. It's going to continue to break things. You just look at the dollar, U.S. versus the top 3 countries in the world. In terms of GDP, it's U.S., China, Japan, Germany. The U.S. in a T-bill, you get almost two times the return. It's the most expensive to short currency on the planet. And yes, all currencies are debasing over time. I fully expect that versus gold, but the dollar versus a basket of other currencies is just unstoppable at the moment until we see that pivot, until we see lower rates in the US, until we see the stock market go down to make the Fed start cutting rates. So there's a bit of the lose-lose for almost all commodities. But in terms of dollar-based gold, it's still the highest ever average price this year. And I love the number too, 1933. That's when FDR debased the U.S. dollar versus gold, which ended the deflation. So it's a little bit higher now, about 1934. But that to me is, let's look at enduring bull markets in commodities. Gold is the most enduring over time, partly because there's limited supply of gold and limited supply of currencies. And then you look at an enduring bear market over time in commodities. It's crude oil. The peak was around 145 in 2008 WTI. The peak last year was around 130. That's lower, and it's made high, lower highs and lower lows. So that's a deflationary asset. So I look at it as expect, as we tilt towards this recession, I still have the key thing I'll end with is typically over time, gold outperforms most commodities, most notably copper and crude oil. And in recessions, it accelerates, and that's what we're tilting towards. I expect gold to be one of the better performing commodities.
Okay, thanks. Yusuf, let's talk a little bit about inflation and obviously how that might be impacting the Gulf region here. Obviously, oil prices are up. We've seen what's happened in Europe and the US with inflation coming under a bit of control, but of course that could reverse any time. What's your sense here of any sensitivity to that in these economies, given what's happening with oil prices, even gasoline prices feeding into that now with the subsidies removed? Could the region be sort of heading towards an unaffordable high cost for its model?
Well, it's definitely quite an important topic to discuss, because the IMF just released a report discussing the situation, particularly in Saudi Arabia, and definitely this is reflected on the region as a whole, about how inflation has been was dealt with during the past year. And what the IMF says is that the kingdom has been able to better control the inflation, and that has been pretty much predominantly supported by putting a ceiling on fuel prices. This was not the case before the COVID pandemic, and I would expect that ceiling to remain in place for some time to come. And that has been why, let's say, a major reason why we have not seen, for example, soaring inflation levels that we saw in Europe or in the US, that north of 5%. So the inflation in this region continues to be around 3% levels. Yet, on the other hand, the prices have not been, or let's say the service inflation and the core inflation as a whole are not the same levels as what we saw before the pandemic. In fact, there is a level of increased level life cost. And that is due to, of course, we see the Federal Reserve continue to hike interest rates, and that raises the borrowing costs in the region because of the currency pegged to the US dollar. But I would say the levels is much better than what you would see in liberal markets, as you see in Europe and in the US. Yet, I think some policies are currently being put in place, especially on the energy subsidies, and that is pretty much putting a ceiling, because there's been a phase out of subsidies, but on the other hand, there is an indirect support of fossil fuels, because there is a report published by Bloomberg the other day, and it says that Saudi Arabia is the highest G20 subsidizing of fossil fuels compared to any other country, $7,000 per person. So I think this has been a major reason why inflation has been a bit in control.
Okay, thanks, Yusuf. There's our survey question for today, which follows yesterday's, which is whether oil would hit $100, which the majority of people said it would by the end of the year. Now, this is about demand destruction, I suppose, OPEC policy. At what point could OPEC pause or even reverse some of the cuts that it declared? Would it be 95, 98, or 100 plus? Mike, just to go to you on that, I mean, you've given us your views, but I mean, how sensitive do you think OPEC policy is to a particular price point? I mean, is it going to just, the minute we see real demand destruction in the US, for example, because, at the end of the day, US has been pretty strong, hasn't it? China, we already have deceleration anyway. So what pointers are OPEC going to look for in that price or in the evidence to possibly pause what they're doing, do you think?
What we anticipate seldom occurs, according to Benjamin Disraeli. So I do like the narrative of $100 a barrel. I think your typical responsive commodity trader, of which I was and which I covered all my life, just can't wait to set up shorts, hope they don't get stopped out, because that's what you do in commodities. You sell rallies and you buy dips. You don't go with too long unless you have a good reason. So as far as what OPEC's going to do, that is, I think, more difficult. But I look at it as they're actually they're responding to what I expect a cartel to do when they can see that demand destruction really kicking in. And the problem is it's also hurting the part of the world we've had incremental demand growth and economic growth in the last 10 years, which is China, which is, I'm viewing China as very close to peak Japan in 1989 and peak Soviet Union in 1991, and just turning over, and OPEC cutting supply and increasing prices to one of their best customers, and of course, China's worked out a deal with Russia, is not going to help this process of tilting the economic growth slower. So to me, this is going to be part of what makes it worse. To make it better, to turn on that demand and to shut off the supply, you need lower prices.
Okay, and just quickly sticking with you, Mike, on the SPR in terms of the US trying to intervene and control prices like as it did last year. It doesn't have much maneuvering room to maneuver there, does it? So again, coming up to an election year next year, etc. How has the US sort of given up trying to influence OPEC policy?
I don't know about that, but I do think, and this is what President Biden did, which is somewhat political, will go down in history as one of the best crude oil trades ever. Partly because, firstly, it's the right thing to do. When you're in steep backwardation, you sell the physical and buy back the futures at a lower price. Now, he hasn't really bought the futures yet, but that's just the essence of inventory management. But there's an issue in this country, and the problem is right now we have an excess of supply. If you just look at US and Canada, total production of liquid fuels is around 28 million barrels a day. Total consumption is around 23. There's an excess supply, 5 million barrels a day. The SPR was back to the days when U.S. was a net importer of crude oil. Now we have an excess supply. Just on the fact of the amount of daily excess of supply in liquid fuels, you can refill the SPR, which is about 350 million barrels, in about 70 or 80 days. That's a big difference from 1979 when I was a gas jockey and we had to price gasoline in half gallons because the pumps are not configured to go above the dollar when prices went above the dollar. So the world, that's a paradigm shift that's changed, and it's part of keeping my bearish, my gloom outlook for the price of crude oil, but not for the producers. Producers should continue to make money.
Okay, thanks, Mike. Look at this. So there we go. We get another majority sort of vote for the $100 mark. It seems like if that's what people are thinking, then we're probably getting there this year at some point before we reverse. Osama, let me just go to you. I mean, Yusuf, before I go to Osama, what did you vote there?
Well, $100 seems something reasonable. I don't think OPEC Plus would want to see prices jumping above $100 because that definitely will hurt consumers.
Okay, but will they wait that long, do you think, for it to hit 100, or will they kind of come in a bit sooner at 98, for example, which is what I put?
Well, to me, I think prices will take a bit of time, maybe until the end of the year, if things go in terms of, let's see what central banks will decide. But I think that if the two factors come together positively for the markets, then we're going to see $100.
Okay. Osama, let's go to you. You talked a bit about electricity prices, and of course, Europe will have its own possible crisis again with gas and electricity if these trends continue. But tell us a bit about food inflation in Pakistan and where we are at now. Of course, when the Ukraine war started, the world was hit with extra food inflation above and beyond what was already happening. But the particular sensitivity of countries like Pakistan and the global south to that.
Yeah, so in case of Pakistan, we have both international and the domestic factors at play that contribute to this mess up, which turns into this food inflation. So Pakistan, ironically, despite being an agrarian economy, still imports a lot of staples, wheat and stuff like that, and most of that was from Ukraine. And as we see that as the prices increase as an aftermath of the Ukrainian war, we have suffered. But also we need to take into account the recent floods the effect of which in monetary terms is said to be around $30 billion. And for an economy of $383 billion, that's a huge figure, right? And then we have this overall global high inflationary cycle going on. That has also downplayed a lot of efforts by the government to sort of curb this food inflation. We have climate. It's spring. We were just talking about 30 degrees and stuff. So Pakistan, we are still. It's supposed to be summers, but we're still around 40, 45 degrees. So you can imagine how that also is counterproductive for many of crops. So there is a lot of going on here, but I still think that one thing that can help or support a food price inflation is that Pakistan wastes around 26% of its food production on annual basis, which amounts to about $4 billion. So that is something that is within our control, and I think that should be given more attention.
Certainly, that's a low-hanging fruit that seems to be quite obvious. Thank you so much, gentlemen. We run out of time for today. Thank you to Osama, Mike, and Yusuf for joining us today on the DEM podcast. Have a great day, everyone. Good to have you back, and look forward to seeing our speakers tomorrow for the last session of the week. Thanks so much.
Thank you.
Bye-bye.
Goodbye.
Bye.